You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Frasers, Aviva, DS Smith, YouGov, AJ Bell, and our US company of the week is Zoom. Sam, shall I kick us off with Frasers?
Absolutely. Quite fitting after doing Boohoo last week as well.
Very much. So we have covered it on the show before, and for anyone who doesn't know, Frasers owns multiple brands, a lot of the high street basically, many of which were sort of failed high street brands, but they're now repackaged under Frasers Group. The biggest of the brands is Sports Direct, but they also have House of Fraser, Flannels, Evans Cycles, Everlast, Game, Slazenger, Jack Wills, USC, and they own around 20 something percent of Boohoo and a similar amount of ASOS, and also a chunk of Hugo Boss. Anyway, half year results, they had half year revenue down by 8.4% to £2.5 billion, driven by declines in their retail operations. Growth at Sports Direct was not enough to offset planned scale backs in the businesses, including Game UK and their premium lifestyle division, where store numbers have more than halved to 37 units. Underlying profit before tax fell by a slower 1.5%, helped by the increase of the contribution from Sports Direct to the revenue mix, cost savings, and efficiency gains from the introduction of warehouse automation. Free cash flow fell from £210 million to £169 million. That was driven by higher internal investment. Share purchases of listed companies such as Boohoo and Hugo Boss and Australia's Accent Group rose by 142.6% to £449 million, contributing £383 million increase in the net debt to £831.3 million. Frasers noted a weaker consumer confidence leading up to and following the UK budget and has reduced its pre-tax guidance range to £550 to £600 million, a fall of 4% at the midpoint, and the shares were down nearly 12.5% in early trading. In terms of valuation, the group have a market cap of just under £2.8 billion and trade at 6.9 times forward earnings, compared with a 10-year average of 14.2, and they don't currently pay a dividend. I thought these results were disappointing, and obviously the market did as well. They're hit at both ends by the rising staffing costs, and then also that decline in consumer spending. I know we've commented on it in a number of different companies, and particularly at Burberry and that kind of higher high street end, which Frasers are trying to move themselves up to. I appreciate they've still got Sports Direct, and that is actually one of the best performing parts of the business. And it's some of those others that traditionally have underperformed and that they've essentially hoovered up, sometimes out of administration. But those horses don't really seem to have turned round, a lot of them. So I think I wouldn't be buying shares. That being said, the shares are very cheap at the moment. But I think for me, if I were looking at a retail business, I'd rather go for either pay up and go for Next, or in preference to that, I'd probably pay up even more and go for the LVMH and just have that premium stable. Even though they're having a difficult time, it's not as bad, and they do have much greater moat against these sorts of downturns. Sam, what are your thoughts on Fraser's results?
Fairly similar. I think a lot of the brands they've got are just quite stodgy. Using Game as an example, I used to really like Game when I was a teenager, and I spent a lot of time in there. But a lot of it was buying physical games, and a lot more of it's digital now. I know that's just one segment, and I think fortunately because Sports Direct's so strong, a lot of these other retail brands, if they do fail, it's not a disaster. But I think when you look at across the board for the brands in that portfolio, they're all going to be majorly hit by the increase in staffing costs,
Mm.
which is not ideal. I think if I wanted more retail exposure, which I don't. I would go for something at the higher end of the market. It would probably be, I'd probably go for ABF or LVMH, but I think Associated British Foods at the moment is one I'd definitely consider because it seems to be one of the few that's actually doing quite well over in the US. And we've seen other ones, such as Boohoo, who are being bought up by Mike Ashley, where they've tried to go into the US and failed. So I think at a forward PE of 6.9, it's not terrible because I just think if you look at the worst case scenario, I think Sports Direct will continue to do okay. And then if any of these other brands actually do quite well or they get a decent amount of cash out of them before they've finished declining, I think it's just a bonus. So I don't think the pricing is outrageous. I just think there's far higher quality businesses that I'd rather own instead. So quite similar to you.
Okay, on to Aviva then.
Yes, so it's just an update on the Aviva and Direct Line saga, which we did speak about a week or two ago. Aviva have now made a new 275p per share proposal for Direct Line, and the board has now reached a preliminary agreement on that. And that represents a 73.3% premium to the closing Direct Line share price before the offer period opened on 27 November. The proposed offer would consist of 129.7p per share in cash and then 0.2867 new Aviva shares per Direct Line share, with a dividend of up to 5p per share subject to completion. Aviva has until 5 p.m. on Christmas Day to make a firm offer, and the shares rose 7.5% following the announcement. I would expect Aviva will make a firm offer. However, the shares are still only trading for Direct Line at 246p, so they're about 30p, so over 10% below the offer price, which suggests the market's not overly confident that it's going to go through, which I can understand because I think we discussed it. And I don't think this offer is that radically different to the last offer we discussed. And it seems they've only managed to negotiate an extra few pence, really, in the grand scheme of things. If I was a Direct Line shareholder, and I think you'd said the same, even at this 275p, I think I'd rather hold on to the business because it's just not that far off where it's been previously. And I know it's a bit of a turnaround, but it seems like that turnaround is starting to happen a bit. And it's been over £3 a share in the last few years. So I still feel like Aviva are probably getting the better end of the deal here. But we'll see what the shareholders think, I guess, when it goes to a vote. John, do you have anything to add?
Not really. I think my position, as you alluded to, be the same as it was last time.
So there's extra few p wouldn't change your opinion then.
It wouldn't swing it, no.
I think what's probably happened maybe is the board feel like they've got to a point where they're not going to squeeze any more out of Aviva in terms of they've got the
Mm,
highest possible price. And I do wonder if behind closed doors, the board just kind of think, well, we'll let the shareholders decide whether they want it or not. But they feel like they've negotiated the best possible offer.
yeah,
Um,
yeah,
but
yeah.
it will be interesting to see the outcome of the vote anyway, and I'm sure we will cover it once we know. But should we move on to DS Smith, another business that might be
Yes,
disappearing from the show?
absolutely. So this, I think we said it last time, but this is probably going to be the last time that we do cover it. Whether it's our favorite box maker or not, we've debated that a couple of times. Anyway, the group had their half year results out with half year revenue dipping by 2%, ignoring currency moves to 3.4 billion pounds. Lower selling prices were only partially offset by a 2% rise in like-for-like volumes. Underlying operating profit fell by 38% to 221 million, in line with expectations. There's a free cash outflow of 69 million pounds, and net debt rose from 2.2 to 2.5 billion pounds over the 6 months. Over the full year, the group expects modest volume growth with improved packaging prices to recover higher input costs. Following shareholder approval, DS Smith and International Paper Group, the combination is expected to be completed in the first quarter of 2025. And an interim dividend of 6.2 pence was announced, which is up 3%. And the shares were down around 1.5% in early trading. In terms of valuation, DS Smith has a market cap of £7.5 billion and trades at 19.3 times forward earnings, compared with a 10-year average of 11.6, and it has a prospective dividend yield of 3.1%. I mean, commenting on these results themselves, I think it's been a tough time, particularly in the last couple of years, with big customers like Amazon previously cutting back with their own reduced customer demand. This is beginning to change now, and whilst we have had those lower packaging prices, and also the rise in terms of energy, the war in Ukraine, and the input costs, it's looking like it's improving. Valuation wise, it's fairly skewed at the moment because of the takeover, but I think it's a quality business. It's very well run. And I know we've been tempted on the valuation basis of buying shares on a couple of occasions. We didn't, and now it looks like it's going to be the takeover is a formality, really. Sam, what are your thoughts on what might be the last set of results from DS Smith?
Yeah, I think they're fine. Cool. We've covered it multiple times. It is a cyclical business, so there's not really any surprises in these results. And I think it is a business where when it's doing well, it's doing very well. I think it's quite a well-run business. We've talked about before, but with the move to more kind of paper packaging, like increase in online sales and stuff like that, it was quite a good play on the increase in online sales going forward, but in quite a low risk way. So it will be a shame to see it go. I understand the shareholders and the board just accepting the highest offer they got, and that's what I would have wanted them to do had I been a shareholder. And however, I would have preferred it if it had gone, if the merger with Mondi had gone ahead, because we would have then been able to carry
Yeah.
on covering the new entity. Whereas I think the odds of us actually choosing International Paper Group as the US company, when I think I'd probably not consider investing in it, given that you do have Mondi in the UK and you probably have to pay a US premium for a similar business. I just don't think it's the kind of thing I'd consider actually covering. So I'd be surprised if we look at it again. But yeah, it will be a shame to see it go because I think it is a quality business.
Yeah. So Mondi might become our default favourite paper company
Yeah, at least we have
or
one in
box maker.
reserve.
Yeah, exactly.
God, we're racing through this week.
Yeah,
So we're going to YouGov.
absolutely.
So YouGov, we have covered it once before. So it was actually only a few months ago that we covered it. It's obviously very well known for the political polls that it's famous for. For anyone who's not familiar, we did cover it. I think it must have been around August time. I also had an interview with Paul Adal in, I think it was, that came out around August, September. And if you listen to that latest interview around the 20-minute mark, he then starts talking about it and he puts forward a very, very strong argument, I think, for why it's quite attractive. So when we last covered it, I think it was a full year trading statement, and we now have the full year results. So there's going to be quite a bit of overlap, but because it was a business that I was potentially interested in investing in, I've decided that I would like to go over the full year results. So there's an investment case, and I did cover this last time, but I'll just go over it briefly. But in terms of the structure of the business, they have over 4,300 clients worldwide, and they're the number one most quoted market research source worldwide. They have three divisions. So the first one is data products, and that makes up 33% of revenue, and that is growing at 10% a year. And that has a 42% adjusted operating profit margin. And this division comprises the syndicated data products, which are available to clients on a subscription basis. It includes their daily brand perception tracker, YouGov Brand Index, and the media planning and segmentation tool. YouGov Profiles, which combined into their YouGov Plan and Track solution, helps marketers plan and execute their campaign strategy and track its success. So it's basically a subscription service if you want some of the more basic generic data for your marketing. The next segment is data services, which makes up 19% of revenue and has underlying growth of -8% at present, and that has an adjusted operating profit margin of 16%. This division comprises of YouGov Real-Time Omnibus Service, which provides clients a fast turnaround, typically under 48 hours, and cost-effective survey service for reaching nationally representative and specialty samples. So if you're a small business doing some research and you just need a quick survey for what you're thinking of doing, you can just basically pay YouGov to do it. And the third segment is custom research, which makes up 48% of revenue. That's got underlying growth of 17% a year, and that has an adjusted operating profit margin of 23%. This division offers a wide range of quantitative and qualitative research, including substantial global trackers that is tailored by sector specialist teams to meet client-specific requirements. They have come out with now their full year results, and revenue was up 3% to 335.3 million on an organic basis. On a reported basis, it was up 30%, but that's because of an acquisition in the year. Adjusted operating profit was up 1% on a reported basis, but down 37% on an underlying basis. Adjusted operating profit margin was down 4% to 15%, and the statutory operating profit was down 75% to 10.9 million. Adjusted basic earnings per share were down 29% to 29.4p, and statutory basic earnings per share were down from 31p to negative 2p. The operating cash generated was down 22% to 53.9 million, and they have swung from a net cash position to net debt of 148 million, and the dividend's up 3% to 9p a share. The revenue growth of 30% reported but 3% underlying, they've said that was with varied performance across the regions. Revenue is slightly ahead of 2024 guidance provided in August 2024 when they issued a profit warning due to higher contribution from the consumer panel services of GfK GmbH, which was one of the acquisitions, owing to greater level of research delivery completed in July. The adjusted operating profit was up by 1%, and that was largely down to the higher CPS contribution. Adjusted operating profit margin was down 400 basis points to 15%, and that was due to weak sales momentum throughout the year and higher levels of staff and technology costs in the first half. Statutory operating profit was down to 10.9 million. They've said that's largely due to exceptional costs related to the acquisition of CPS and the change in accounting treatment of amortization, costs of acquired consumer relationships, intangible assets, and restructuring charges. Adjusted earnings per share was down by 29% to 29.4p. In terms of the operational highlights, they completed the transformational acquisition of CPS, the European leader in household purchase data across 18 countries, for a headline purchase price of 315 million euros in January 2024. So that's why the debt's gone from net cash to net debt to fund that acquisition. Interestingly, one of the things Paul mentioned in his interview was when they've got this CPS business, that was two data companies that were merging, and they couldn't, basically for competition reasons, they couldn't get the merger through unless they spat out this division.
Okay.
And neither of them actually wanted to spit it out, which I think is quite interesting. And what they've got is actually quite, the companies would have liked to keep it in an ideal world, but they had to get rid of it to get this merger through. So the CPS business, they've said, is continuing to perform well in line with expectations, and the integration is progressing well. The top line performance was impacted by slower than anticipated sales momentum, heightened competitive activity, and challenging macro conditions. So again, something that Paul mentioned is they've had more competition, and that's why one of the segments is starting to decline. This, I think it's the CEO, or if not someone senior in the management, has come out and said they think that's temporary, and they think that the competitors, because they don't have all the data that YouGov has, they don't think the competition will actually be as valuable. So they expect a lot of that revenue to come back. Whether or not it does, we will see. But I think the argument that they've got their data is better is probably a strong one, given how much data they have. The Americas saw strong underlying growth of 8%. And again, it was mentioned in the Paul interview, but I think nearly 50% of their revenue now comes from the US. And that's been driven by an increase in spend from the technology sector and multi-year tracking studies. The region remains their key strategic focus area, and they continue to see significant market opportunities over the near and medium term. They also completed the acquisition of Yabble post the end of the period, which will transform their data product segment, maximizing the capabilities of Yabble's industry-leading AI platform with YouGov's superior quality data. They announced in August a cost optimization plan, and that's basically just they want to cut 20 million of costs, and 70% of the annualized cost savings are expected to be realized in the next financial year, but weighted towards the second half. I think that sounds fine. I don't massively like it when companies try and cut their way to growth. But I think in this case, because they've just done such a big acquisition for 315 million euros, it doesn't seem inconceivable that there could be 20 million of annualized costs that are actually unnecessary, given like the duplication across the different businesses. So that seems fine, I think. And they've said alongside the cost optimization plan, they'll focus investments on areas with greatest potential for growth and return, which include enhancing their data products to make their rich, high-quality data more discoverable, further building out their AI-enabled capabilities to enhance product offer and operational efficiency, strengthening of their sales organization through the appointment of new regional leaders for UK and Europe, Middle East, and Africa to drive improved performance and increase their commercial rigor, and expanding CPS panel capabilities and data collection methods to accelerate their growth potential. And then for the new financial year in the outlook, they've said trading for the current financial year is broadly in line with the prior year as expected, reflecting the slower sales bookings in the second half of 2024. They continue to see demand for their high quality custom research data while seeing longer sales cycles for data product subscription sales. Sales bookings momentum is expected to pick up in Q2 and Q3 of the current financial year as they head into renewal season for data products, supported by the launch of new products and features, as well as an improvement in market conditions. They expect the group to meet current market expectations for the 2025 year, which will be second half weighted due to the ongoing restructuring process. In terms of the valuation, the business trades at a PE of 15.5 and has a dividend yield of 2%, and the market cap's only 521 million. We discussed it last time with the trading statement, but I think at a PE of 15.5, I think it's pretty reasonable. I don't think these figures are terrible. I think they're not great, but that's why it's at a PE of 15.5. And I think if they can turn it around, and I think there's some strong arguments that can in terms of the quality of the data, the fact that they are in a growth market, the American growth is positive, which I think is quite a good thing to see, given that's probably where the future of the revenue growth is going to come from. And then you've got the kind of the add-on of the cost savings, but as well, it's going to be the first year where they've fully integrated that very sizable acquisition. Because you're talking about 300 million euro acquisition on a business with a market cap of 500 million pounds. So if they can really get this going, then I think that could be quite transformative for the business. But I think it is a turnaround. I think there is some risk because of that, especially if some of the business is starting to doesn't come back, and their product maybe is more homogenous than they actually thought it was, and their data is maybe not that valuable compared to what other people can offer, or what other services can offer for the price is actually still an attractive proposition. So we'll see what happens. But I think it's a business with optionality. It's a business with a lot of levers I think they can pull. I think I'm starting to get quite interested in this business. And it's possible that after having a bit more of a look this time, that I might take a nibble in the next week or so and
Yeah.
start a position. Because I think if we compare it to for example, another business that we like and have covered on the show, Trustpilot.
Mm.
Trustpilot trades at like 50 times earnings, and it's a quality business, but is it 3 or 4 times better than YouGov? I don't think it is. And I think there's a lot of reasons to believe why this turnaround could happen. I think they've got a lot of tailwinds. And if not, when it's already trading at 15 times earnings, how low is it going to drop? Because I don't see this as a business that's going to go into structural decline. Because two of the three segments we covered are actually growing quite nicely. So even if some of the data services doesn't come back, I don't think it's a huge problem. It's not catastrophic. So I like the look of this, and I think these, whilst not amazing results, I think there's quite a lot to be hopeful about. What about you, John?
Yeah, no, I'm actually in the same boat on this. And I think the more that we've looked at it, the more I've liked it. The margins in the areas that it operates in are pretty good. And if it can get back to that growth, the 15.5 times earnings, whatever it is, looks fairly cheap for what is a high quality business. It would be FTSE 250 now.
It's on the aim. So in
That,
terms of size, it would have been, yeah, but it is on the aim.
But no, I think there's an awful lot going for this. You would be obviously taking some risk with it, but as you say, it is mitigated to a degree by the current valuation, well, relatively lowly valuation. So
Well,
yeah,
that's it.
I
I think
like it.
if you want this kind of business with lower risk, go and pay 3 times PE for
Yeah,
Trustpilot.
yeah, yeah, no, absolutely. So yeah, no, I'm keen and may also take a nibble too.
So actually, I hadn't realised, but so just looking at the revenue by geography, America's 124 million out of 335 million. There's some intragroup revenues of negative 18 million, so this isn't going to add up exactly. But UK 69 million, America's is 124, so it's actually pretty much double UK. Europe, Middle East, and Africa is 141, and then Asia Pacific's 19.6. Asia's actually declining, although it doesn't matter because it's tiny. I know it's not ideal, but it is tiny. Europe, Middle East, and Africa has gone from 69 to 141. So I think the acquisition must have been big in Europe. And then America, that's up underlying 8%, but 5% when you factor in currency changes. And the UK revenue is actually up 3%. But yeah, the American size segment's already twice as big as the UK and it's growing at a faster rate. So it's probably a more diversified business than I'd actually expected it to be.
Yeah, yeah, no, absolutely. I think it looks good.
Yeah, so I don't think it'll be a full position, but I think I'll probably have a nibble in the next week or two as a early Christmas present for myself.
Shall we move on to AJ Bell then?
Absolutely. How are they doing?
So they're doing very well actually. They had their full year results out last week. And for anyone who doesn't know, I should say that AJ Bell, it's the UK's second largest sort of DIY investment platform. Hargreaves was, I suppose, our favourite, your favourite. You did own shares in it, but then that's been acquired by private equity. Hence, we're not covering that anymore. And AJ Bell, it was always Hargreaves' competitor, and it's the number two in the UK. So full year results out, and in terms of some of the key highlights, revenue was up 23% to £269.4 million. Profit before tax up 29% to 113.3 million. Earnings per share up 23% to 20.34 pence a share, and operating margin came in at 42%. Assets under administration up by 21% to £92.2 billion, and customer growth reached 557,000, which was up 13% year on year. And customer retention remained high at 94.2%. The group spent on enhancing brand awareness. They also reduced fees, improving their competitiveness and the platform ease of use. They introduced AJ Bell Touch for advisors and an enhanced direct-to-consumer offering via the AJ Bell Doddle, which is the kind of low-cost platform, which was aimed at younger investors. Dividends, they increased by 16% to 12.5 pence a share, and they announced a share buyback programme worth £30 million, reflecting the strong capital generation. They do comment on the general UK platform market and say it's estimated to be worth about 1.1 trillion, and they're growing market share within this. And they do also comment about their dual model where they've got their advised and then their direct consumer product, and that was something that was slightly different from Hargreaves Lansdown. Coming to valuation then, they have a market cap of £2 billion and they trade at just under 24 times earnings with a dividend yield of 2.37%. I thought these results were very good. To a degree, it is reflected in the valuation, but they're impressive nonetheless. It's not a sector that I traditionally have liked, and I think that to a degree it is a race to the bottom in having the most competitive, lowest fees. I guess this is something that AJ Bell are able to mitigate a little bit with some of the advisory, which is higher margin, and they do seem to be doing a good job, despite my reluctance for the industry. So yeah, I don't think you can knock these results at all, and I think they're probably deserving of that premium valuation. Sam, what are your thoughts on these results in AJ Bell?
I think the results are excellent. I don't think there's really anything to criticize in these results. However, I think what I learned the hard way as a Hargreaves shareholder is I think the product is much more of a commodity than I'd thought. I think it's a very cyclical business, and I think that's maybe not reflected in the price. I think when you look at these results, if they can do that every half for the next few years, a PE of just under 24 is pretty reasonable, but it is so cyclical, and I think their fate will rise and fall with interest rates as well. That seems to be the case with recently. I just kind of feel like it's a fairly expensive PE. I know it's maybe got a bit more growth in it because it's only number two and it's gaining market share, but I just think you're paying quite a lot for what I'd consider to be quite a cyclical business. I think maybe one advantage is possibly that with Hargreaves being bought by private equity, I think it's rare that a business gets bought by private equity and is made better as a consequence. I think they will start looking to charge more where they can, and there might be a bit more drain of Hargreaves customers. Another thing that's a bit concerning for me is I'd always thought it was quite sticky. It's a bit of a hassle moving your investment provider. And that was based on my own experience. And I think that's true to a degree, but maybe not as true as I thought. So as an example, I've now got accounts with, I think I've got Halifax, Hargreaves, AJ Bell, and Trading 212 as well. And I think because I'm now at a position where for different accounts, depending on who's had the most attractive rate of interest or whatever else, I've ended up with a few of them. Going forward, I'm probably much more likely to move them around now. Whereas before, if you go back 2 or 3 years, pretty much everything was on Hargreaves. So I think, again, it's just anecdotal, but in my own experience, it's not been as sticky. I think I also had a bit of a bias towards Hargreaves because I was a shareholder, and I think that maybe made me less likely to switch. And now that it's been bought out and I've sold it, I've within months I've opened a SIP on AJ Bell.
Yeah.
So if I'm just using, so I think maybe I weren't giving my own biases enough credit in terms of my loyalty to Hargreaves. But I do like the Hargreaves platform. But then the AJ Bell platform's just as easy to use. So I think you can make an argument for it, but I'd be very wary paying this kind of valuation for it when I think it's such a cyclical business.
Yeah, no, fair enough. Because I've been on a few platforms as well, and generally, I think if you're on some of the bigger ones, the transfers are relatively smooth. And with the big platforms, I do find them all quite straightforward to use. I don't think there's, they all have apps now which are pretty slick. I don't think there's a huge advantage one over the other. I know you mentioned Halifax. I have used Halifax in the past as well, and perhaps that one was a little bit dated, although it was reflected in the lower fees that they were probably able to charge as a result.
Yeah, I just think having gone through the process of like, because I've now moved a couple of times, I think. Because I think I had an ISA with Halifax that I
Mm,
moved to Hargreaves. Oh no, I think I maybe had an ordinary investing account that I moved to Hargreaves and kept an ISA with Halifax. And then I've got a pension that I moved into AJ Bell when I set up my SIP. I think now, having been through that process of switching a couple of times, it's a bit of a faff, but you literally just fill out one form and then probably have to send some ID as well to confirm it's actually you trying to make the transfer. And that's basically it. And I actually found it a lot easier to switch this time with the SIP to AJ Bell than 3 or 4 years ago when I switched the trading account over to Hargreaves. So I think even in the last few years since I'd done it, the process had become a lot easier because I remember with Halifax moving that over, it took absolutely months. I think it must have taken about 3 months. Whereas when I was moving the pension from Standard Life to AJ, it was much easier. And as well,
mm.
because the apps were so much, I mean, that might have just been reflective in, like you say, Halifax being dated, but I was on Standard Life and within the app, it was taking a bit of a while. And I sent a message within the app, and like within 24 hours, they'd started moving it. So it was a lot easier this time, actually. And I think that probably means I'm much more likely to switch again in the future.
Yeah, and it's particularly if you see, whatever the market beating rate is for say platform fee, and you work out how much is in your SIP, and then you're like, oh, that is quite a lot. And yeah, it's a bit of a hassle filling out the form, but as you say, it's not as painful as it probably once was, and that, filling that out might save you £1,000 or some relatively large amount of money. And then also, if you do the compounding calculations at how much it would save you in the future, then it's even more of a motivating factor to go out and do it.
Yeah, so I think it's less sticky
Mm,
firstly than I thought it was. But I think the problem is as time goes on, it becomes less and less sticky anyway because the apps and stuff just make it so easy to switch.
yeah.
And from like AJ Bell's point of view, they were so desperate to, they're so desperate to get you to bring everything else over that on the AJ Bell side, it actually couldn't really have been more straightforward to switch. It was just I had to chase it up with Standard Life, which isn't that surprising given it was them I was moving away from. So it wasn't as much of a priority for them. But on the AJ Bell side, very easy. They were constantly sending emails saying, "This is the status of it. This is what we're going to do if we don't get a response by this date."
Yeah.
It was super easy actually. It was to the point where it wasn't quite automated, but it almost felt like that.
Yeah.
But yeah, so I think because of that, I'd be very hesitant with AJ Bell, even though I think these results are excellent.
Yeah. Yeah. No, fair enough. Okay. On to a favorite from lockdown then, Sam, Zoom.
Yes, so we have covered it, I think, once or twice before, but we've not covered it for a couple of years. So Zoom, I don't think they really need much of an introduction. We're recording the podcast on them. I think everyone, or virtually everyone, has used it and them at this point, or if not, has an awareness of them at least, have come out with their Q3 results. And revenue was up 3.6% year over year to 1.177 billion, and all these figures are in dollars. Enterprise revenue was 698 million, up 5.8% year over year, and online revenue was 478 million, which was flat. GAAP income from operations was 182.8 million compared to 169.4 million a year ago. Non-GAAP income, which adjusts for stock-based compensation expense and related payroll taxes, acquisition-related expenses, and litigation settlements, was 457 million compared to 447 million a year ago. I'd be inclined to use the GAAP revenue, which keeps all that stuff in, which I think are real costs, whether they like it or not. But yes, for the third quarter, GAAP operating margin was 15.5% and non-GAAP was 38.9%. Again, in terms of that GAAP margin of 15.5%, I think that's quite disappointing, actually. I would have thought, especially given it's been a couple of years since we covered it, but I would have thought Zoom would have been a business where it should have a very, very high operating margin because you wouldn't have thought it needs loads and loads of costs, especially on the staffing side. So I think that's actually a bit disappointing, and I would have expected that to be higher, but that's from like quite an ignorant view going in that we don't look at it very often. GAAP net income for the quarter was 207 million or 66 cents a share compared to 142 million or 45 cents a share a year ago. Non-GAAP net income, which makes the same adjustments as we mentioned before, was 435 million or $1.38 a share compared to 401 million or $1.29 a share a year ago. They've got total cash and equivalents at 31 October of $7.7 billion. And net cash provided by operating activities was 483 million for the quarter compared to 493 million a year ago, down 2% year over year. Free cash flow was 457 million compared to 453 million a year ago, which was up 1% over year. At the end of the third quarter, they had 3,995 customers contributing more than $100,000 in trading 12-month revenue, which was up 7.1% from the same quarter last year, and they had approximately 192,400 enterprise customers. On a trailing 12-month net dollar expansion rate for enterprise customers, it was 98%, and online average monthly churn was 2.7% for the quarter, which was down 30 basis points from a year ago. The percentage of total online monthly recurring revenue from online customers with a continual term of service of at least 16 months was 74.1%, up 90 basis points year over year. And in November 2024, the board authorized the repurchase of an additional 1.2 billion of common stock. And that was in addition to the previously authorized share repurchase for a total of 2 billion, which remains of that. In terms of valuation, the business trades at a PE of 28, has a market cap of 25.6 billion, and trades at 15 times free cash flow. I think these results are okay. They're probably not what I would have hoped, having not looked at the business for a couple of years. And I think there's quite a few things to be optimistic about. I would have expected higher margins. I think the growth is a bit sluggish. I think maybe last time we probably put it down to COVID growth being pulled forward, but I guess it's maybe at the point now where everyone who wants a Zoom account pretty much has it. And there's not that many people sat around that haven't heard of Zoom. And I think although on a free cash flow basis it's quite attractive, when you look at the adjustments to go from, for example, the operating profit to the adjusted, there's actually quite a lot of stock-based compensation. And I think I've not worked out what it is, but it seems like that's quite high. So I think although the free cash flow is relatively attractive, it seems the performance since COVID to me looks a bit sluggish. Don't think it's a terrible business. I think at 15 times free cash flow, you can do a lot worse, but it doesn't seem like there's a lot they can do to grow it. And I think partly an issue is as well, they don't really have a huge amount, as far as I'm aware, besides the core Zoom product. But then as well, it's how hard can they push on the pricing side when if they push you too hard, you'll probably just switch to Microsoft Teams, especially for people who are already paying for some kind of Microsoft package, which is virtually every business on the planet, I imagine. So yeah, probably, I think last time it was, I think I was a bit more attracted to it, but I think after seeing this, and maybe it's a bit more sluggish than I expected. What do you think, John?
Yeah, I think it's very expensive, and I think the margins you'd expect them to be greater, and it's a bit sluggish in terms of the growth at the moment for the current valuation. So yeah, it's not something that I would be really looking again at for a while, I don't think.
No, I was a bit disappointed when I saw this actually, but that's life. So there's no point dwelling on it. So of the 6 businesses we've covered, Frasers, do Aviva and Direct Line in what as one, assuming that the takeover will go ahead. DS Smith, YouGov, AJ Bell, and Zoom. Which do you like the most, and which do you like the least?
I definitely like YouGov the most. I think that's a quality find, and I may well take a position in it. In terms of what I like least, I probably it's a bit harsh towards Zoom. I think probably Zoom on the valuation. I could make maybe more of a value case for Frasers itself, but that would also be sort of down there at the bottom this week.
I think for me, top, it would be quite easy. It would be YouGov. I think bottom, I'd probably go AJ Bell, but I think AJ Bell itself looks like a good business that's performing well. I just really don't like the industry. So it's a bit harsh on AJ Bell, but I think I would caveat it with there's not really anything AJ Bell could do that would change that other than change their industry.
Fair enough. Well, thank you again for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.